Thank you very much. And thank you everyone for being here today. When we put together the idea of this session, as Dan mentioned, finding opportunity in the chaos of our current uncertain global macro environment, and I didn't quite think it would be quite as relevant as it still is today. And I was rather hoping that it would be less relevant, but here we are. The good thing is we have the perfect person to talk to today in terms of that. We have with us, hopefully he's going to come up on the screen, Suhail Shaikh, who's the Chief Investment Officer of Fulcrum Asset Management. Suhail joined Fulcrum in 2005 and is also the portfolio manager of Fulcrum's discretionary macro and diversified absolute return strategies. Prior to joining Fulcrum about 21 years ago now, although he doesn't look it, I can tell. Suhail was at Goldman Sachs for 5 years in their investment management division in macro asset allocation. So please join with me in thanking Suhail for dialing in all the way from London.
Andrew, can you hear me okay?
Yes, we can. That's perfect. So the first thing that I wanted to dive into is what we were talking about in the title of this presentation. We all know we're dealing with these uncertain global environments. Certainly in our world, in Infinity Asset Management, we're wrangling with this every day across our multi-asset portfolios. How do we manage it? How do you, as Kerry said, how do you hedge a risk that you don't know exists? But in your world, Suhail, this risk and this uncertainty actually presents quite a lot of opportunities. So how do you think about this political uncertainty, this geopolitical uncertainty, energy markets, precious metals markets, which have been extremely volatile, as potentially an opportunity, not just a risk?
Sure. The way I break out the various risks are you're currently having a volatility shock, especially in energy. You also are having correlation shocks in terms of stocks and bonds selling off together. Gold is doing something most people probably wouldn't have predicted. Gold would be one of the worst performers in a geopolitical shock of this nature. And that relates to the third component, which is a deleveraging shock. I'd say in the 25 years that I've done this, markets, investors, hedge funds probably haven't been as crowded in the same trades entering March many more times. And when you see highly leveraged exposures get hit by this sort of shock, crowded positions could suddenly break all sorts of correlations where fundamentals may suggest that gold should do well, the dollar should do better, but it doesn't happen. Fundamentals may suggest that the VIX should jump a lot, but it's not, because there's so much sort of sector rotation within single stocks. The microstructure of who holds the equities, who's deleveraging the equities is very different today than it was maybe 15 years ago. If I just think about that from a hedge fund space, 15, 20 years ago, 20 of the biggest hedge funds tended to be long biased, concentrated. The deleveraging that occurred in a Viking or an Elliott would take the stock market down. Whereas today, the deleveraging occurs in maybe a Exodus Point or a Citadel or a 0.72. And there you're deleveraging lows and shorts at the same time. You see big dispersion in underlying stocks, but maybe the index doesn't move as much. So I think the world has changed. And what I would first say is this is an environment to survive first, rather than try and be a hero. Because I'll give you an example. We made a lot of money last year. Thankfully, we're profitable this year as well, but we made a lot of money last year in Italy on the tariff shock. We got the tariff shock right, but actually the asset price implications were completely different to what we expected over the next few months. So it's really important to first understand that even if you know where this Iranian situation will head, doesn't necessarily mean that you'll get the asset price implications correct. And even if you get the asset price implications correct, it doesn't mean you'll be able to tolerate the tacos and the noise and so on that happens in B2B, especially if you have a daily liquidity strategy where clients are looking for your daily returns to never get, way out of whack. And it's almost impossible to predict what's going to happen. And it's impossible to, pick that falling knife and get the timing exactly right. And so I think there are major opportunities, but first and foremost, I see this as a dangerous environment where the probability of a really big accident is probably 20 to 25%. The probability that Middle East tensions really escalate, I was listening to what Kerry had to say, and I think broadly I have sympathy for many things. But it's not just up to Trump in this particular situation to end the war. As many people have been saying, it takes 2 or 3 to tackle. We don't exactly know where this where this scenario will end up, but there is, I would say, it's got a lot of complacency. And if you look at oil vol at 100, 110, you had S&P vol at 23. If you look at Eurodot vol at 6, 7, there are lots of opportunities when you look across markets where you don't necessarily have to take a view on something that no one can really take a view on, i.e. what's the outcome. I'm trying to find always mispricings across asset classes. Silver and gold are down 18 to 27%. They're severely oversold. There's good reasons to believe that there's been a significant deleveraging in the Asian retail community there. There's sensible reasons to believe that Turkey and other central banks have been selling their reserves to defend their currencies. So again, if we can try and think about, try to understand how much of this has already happened, then we can try and assess where's volatility already moved, where may move, what correlations are legitimately, they're breaking, but they're logical. Like the bond equity correlation breaking here makes complete sense. This is a stagflationary shock. The inflation effects are going to be very material on the UK, on Asia, maybe less so in the US. And therefore, rate hikes may have to occur where previously people thought rate cuts were there. That will cause pain in equity markets too. So bonds and stocks sell off together. The deleveraging part is the slightly unusual one that has made this particularly hard. I'd say, again, in the 25 years I've done this, this is one of the hardest times because of how correlations are broken across markets. So we are tight then, but we are also trying to survive at the same time because we have to. The best way to make money over time is don't lose too much in the first place. And I think there are some pretty good towards a lot of money at the moment.
That's brilliant. You mentioned that trade-off between trying to make money, trying to be active, get in front of whatever trade might be going on in the moment, and the portfolio construction, the breadth of the portfolio construction. We'll probably talk more about the Iran situation in a little bit towards the end of the session, but maybe just focusing in on that precious metals situation that we've had this extraordinary volatility, particularly through the first bit of this year, huge run up in gold and silver, very significant sell-off in the last week. That's been quite a happy hunting ground for your strategy. How have you gone about that, and how have you also blended that into the overall portfolio construct?
Okay, so we've been positively inclined towards gold for 3 years, really driven by the expropriation of Russian reserves. And what that might mean is, as your prior speaker was saying, about de-dollarization and people trying to get something else other than the dollar. And it's a bit of an ugly contest in terms of the rest of the currencies. And therefore, there's been a lot of central buying in gold. But nothing goes up in a straight line. And I'm always looking for dislocations between gold and real bond deals, or gold and silver, gold in the dollar, or if something has gone up too much too quickly. And the too much too quickly isn't something that I would look at in dollars or in percentage terms. It has to be related to the vol of the environment. In an environment where silver is moving 10% a week, for it to become oversold, it might have to sell off 25%. Right? But if something is moving 4% a week, well, then maybe 10 or 12% sell off or value is overbought or oversold. So again, I tend to try and take a strategic view, but don't buy your own stories that this is the best thing. The reality is we don't know what the value of gold should be or what the value of silver should be. It's hard to put a fundamental number on something like that. So I tend to look at crowdedness of CTAs and hedge funds, and retail are massively involved. Then we'll tend to be a little bit more cautious. I was in Australia in February when we met. I was in Singapore just before. And again, when you see Market Street full of people in Sydney buying, selling gold, where you see in Asia the private clients that I'm speaking to in accumulator structures where they're just geared leverage buying silver and gold, you know that there's an accident around the corner. You don't necessarily know when it will happen in 50% from here or not. but at least you know you're probably in a bubble. And when you're in a bubble, it doesn't mean you should get out, but it does mean you need to be very risk aware in your structuring. And so the way you've traded gold well is be through options. And I'll give you an example of how constraints are a problem. And um, uh, earlier we were talking about complexity, and I've always believed you need to embrace complexity. In the UCITS world, so we manage this liquid oil strategy in Australia in the unit trust, and we manage the same strategy in the US in a mutual fund, and in Europe in a UCITS structure. And UCITS has the regulators here have the bright idea of preventing you trading any commodity futures or commodity options. And just for example, year to date, the Australian strategy we have is up 8, but the UCITS is up 4. It's the same strategy, but buying Delta One positions, being unable to structure them properly in options and so on, is a big cost when you have these sorts of massive volatility events. And so I think it is super important to understand what constraints do and why complexity is required. So in terms of gold, we own gold. It's the main thing I'd say we've got wrong in this month in March, but at least we were able to hedge it in a way where the damage was limited. And I think it's really dangerous to try and get in love with any asset. These are all assets. They can go up and they can go down. Be disciplined in your risk management. When something is not behaving the way it's supposed to, the way you expect, get out is typically the best strategy, and reassess.
So, Sahel, one of the challenges, and I know in the room we have a lot of asset allocators, advisors, asset owners, and the like. One of the issues that we often hear, and I'm sure you often hear as well, is diversifying strategies, whether it be global macro strategies that, alts that tend to be pro volatility. They often have quite a significant opportunity cost through time. And the trade-off for an asset allocator is, one, do I try and time when I need the protection and that pro volatility kind of protection, versus how much it costs me over the normal periods, the non-dislocated periods, in the lead up to that. Should I try and time it, or do I just wear that through those normal environments? Is there something that you're conscious of, and how do you go about trying to avoid too much opportunity costs in the long run for those opportunities to diversify when markets are dislocated?
So this is something that we all evolve and we learn. And I think this is an area that I've learned a lot about through experience of the last 25 years of managing the last 20 years of managing liquid alts, daily liquidity portfolio. And we've made some mistakes, I would say, that we've tried to address. And those lessons, I think the liquid alt space should also learn, in my view, to succeed. So number one is think about what you're being funded from and take enough vol to beat the funding source. So if a client is selling equities and you know that to buy you, well, then you should be running at 12 vol probably, have a decent chance of generating a higher return than equities. If you do sell equities and buy a 4 vol fantastic liquid alts, then basically it's on a bear market. There's a bear market in stocks, and the hedge fund will outperform, or the liquid alts will outperform. And if it's not a bear market, then you probably resent and regret that decision for many years. So if you're funding from bonds, on the other hand, I think then perhaps you can have slightly less volatile strategy. But nonetheless, I think it's really important that liquid alts take enough volatility to beat what they're funding. And so we had 15-year history of running 5 vol, and we had a tendency to do really well, like you were suggesting, when things went wrong in 2008 and taper tantrum. But we were being people in good times and not making enough money. And over 10 years, underperforming the funding source, which was equities or balanced portfolios. And so it just wasn't a sensible business spot. What tended to happen is we would get lots of inflows after a crash. And then we'd have somewhat disappointed clients after the fact because they've invested in us too late. And so we kind of took that on the chin. And about 5 years ago, we said, okay, this doesn't make sense. What we need to do is stop being so bearish all the time, use our skill in structuring to participate in the good times as well, but do it in a way where if we're wrong, we don't get big losses at the same time that the equity market crashes out, but the bond market crashes out. And so the way I like to term it is we've really tried to focus on two-way convexity. If there's money to be made in silver, in the Kospi, in emerging market bonds on the upside, we will try and make that, but we will structure it in a way that we can afford to be wrong without the client really noticing that we were wrong. So two things: take more vol. So we run around 7 vol, and that's what we've been doing for the last 2 years. And then try and generate good returns in benign periods so that clients own you before the crash and they're happy with your performance for them during the crash, rather than wish they had you in the crash, come after the fact and be disappointed. So these are behavioral lessons, right? So those are the two most important things that I think liquid alts need to do.
Just off the back of that, I mean, you mentioned about the importance of taking the enough volatility in your alternatives allocation, whether it's for a client portfolio or on a standalone basis. But I'm sure that there's plenty of people that hear you say, so we want to take more vol in a diversifying strategy, that say, well, I don't understand that. If I'm funding it from equities, and that's got a certain volatility, I'm going into alts that also has the same volatility. Surely it doesn't give me the diversifying benefit. So could you just touch on the different types of vol that advisors and allocators should be thinking about with their alts allocation?
I think this is an extension of risk budgeting and risk parity. For example, if you go back 20 years when AQR and Bridgewater, or slightly longer, created their risk parity funds, it was to take advantage of uncorrelated bond returns in an equity portfolio, where if you simply sold some equities and put them into bonds, yes, that did make some sense, but it didn't really exploit diversification potential, because one asset had a 4 vol, one had a 15 vol. In the same way, liquid alts can provide fantastic diversification, but if they run very low vol, unless you put a very large allocation, which becomes quite difficult to fund, it's almost impossible for that to move the needle for the overall portfolio. And so I think they have to take vol. And if a client has enough resources or consultant relationships or whatever it might be to combine 8 or 10 liquid alts at 10 vol each to become 6, well, maybe that's a great way to do it too. I'm not saying you put it all into one fund, but it's very important to take enough risk. Otherwise, you're putting a very high burden on the skill and Sharpe ratio of the manager to generate enough return to beat the funding source. Now, risk doesn't mean equity beta. That's the other thing that's very important. All right. So taking more risk, the three main types of risks are beta risk, which doesn't really diversify. Equity beta risk won't diversify. There's leverage risk. That's the main one that we're taking. There is leverage at complexity when you have relative attitude trades and option trades and curve trades and so on. And then the third one is you could take illiquidity risk. As a liquid alt, hopefully it should be clear that you should take illiquidity risk, but we don't do that. We don't take the equity risk. We take leverage risk, and we use our skill to take opportunistic two-way convexity risk, whether that's the equity market surging or crashing, rather than just focus all your energy on making money when things go wrong. Well, then you just don't make enough money over time.
Yeah, it's a challenge that we face into, at Infinity. Full disclosure, I've known Suhail for a long time, and we're one of the big supporters here in Australia of the strategy, and it does this really well. But we find it quite hard to find strategies that take enough risk and to decompose the kinds of risk or the volatility that they're taking. Because often with these kinds of strategies, you find that in the underlying, or when you dig deeper and deeper and deeper, there's always a little bit more of that beta risk that's coming in than you might think up front. So from your side of the desk, Suhail, how would you recommend, as a professional practitioner in this space, asset allocators and advisors sort of try and unpick what types of risk yourself or other managers might be taking in their strategies? What sort of questions should they ask? What should they be looking out for?
Okay, so I've used the word complexity a few times, as have other speakers here. These are complex strategies. The complex strategies do not need to be opaque, right? So what I try and do, and if I was sitting on the other side speaking to another manager, if you have an uncorrelated strategy, then almost by definition, it's hard to pinpoint why it makes money by just looking at one market, because the whole point is it's supposed to be uncorrelated. But if you take a step back or step forward even and peel the onion, then there should be building blocks within that strategy where the building blocks are understandable. And so, for example, in our strategy, there's an asset allocation building block. Well, quiz us on the strategy, understand the loan bias that it has towards equities, understand how it's measuring risk, what are the good environments, what are the bad environments, ask for the attribution by month or by year of that strategy so you can really understand it. We have a macro discretionary component, which is the big part, and that has many different sleeves. There's a trend following sleeve, there's a dispersion sleeve, there's a market neutral equity sleeve, there's a global macro sleeve. Decompose those returns and benchmark them to the best macro hedge funds, the best CTAs, and the best market neutral, if you see what I mean. So if you can, I don't think it's good enough to say we're complex, trust us. I think it's okay to say you need complexity to be uncorrelated. Nothing buy and hold, long only will be, nobody is skilled enough to make a buy and hold portfolio uncorrelated. I often use an example where if you knew with hindsight, with perfect foresight, whether stocks or bonds would outperform in any month, and you put all of your money in stocks in the good month and bonds in the outperforming month, you'd still be over 90% correlated to a balanced portfolio. You can't become diversified by being long only stocks and bonds. And then you need shorting and ISDAs and stop losses and all this complex stuff, which is required. But it also means when liquids lose money, people lose faith very quickly because they don't really understand what they've bought, which is why what I've tried to do over the last 20 years is embrace that complexity, but take the time with clients to show them the transparency of what you actually own in positions, in philosophy, in risk management, in attribution. And so that detail, if there's one set of data that I would love to get as an allocator of any manager, is how many views do they have? What is their hit ratio? And what is the asymmetry on each of the views? And that is how I would determine whether they've swum the bat and fluked it or actually have skill that is persistent and hopefully can be extrapolated in the future. Sorry, that was a long answer, but that's the sort of stuff I look for.
No, that's perfect. Maybe in the last 10 minutes or so, that's extremely helpful, in terms of the way that advisors and allocators should think about alternatives, particularly their role in portfolios, and also how to assess those types of strategies and for efficacy and whether they fit that role. I wonder if we could just take the last 10 minutes or so to talk about, obviously, the ongoing situation in Iran and the volatility that we're seeing and uncertainty that we're seeing in markets, not just from what you're doing in the portfolio, but also how you see it from a macro perspective. Obviously, Fulcrum is at its heart a global macro fund and investment manager with an enormous amount of expertise in these areas. So in terms of the current environment, what do you think are the key risks, likely outcomes, and how are you positioning for those?
Okay. So if I'm very lucky to have Gavin Davies as a partner here. He was chief economist at Goldman. He expanded the business, and the relationship we have is I focus a lot on trading, like you would do in prop desk, and he focuses on the economic research, like you would do in a bank, to facilitate that trading in a prop desk. So, and that's what Gavin used to do at Goldman in the sort of 90s, 2000s, and so on. And he has a team of 12 people who are there really to do all of the research into anything that helps us make money, whether that's on asset allocation, it's on volatility, on Iran, on general geopolitics, activity, inflation, and so on. I might just go through some of the highlights of what we're thinking or what they're thinking, because they're the experts in this, about the inflation impacts. So the highlight number one would be at $140, $150 oil, this is a global recession. If we have 3 or 4 months at that level of oil prices, then we will probably almost certainly have a global recession. And the modeling that we do is based on Brent and WTI. There's a slight difference that's happening this time, which is, I think, quite important. The product prices have surged even more. So if you look at jet fuel and diesel and so on, if you think about the inflation impacts that we could see from these end product prices, it could actually be a lot worse or happen at a much lower oil price than we we're previously thinking. The bottom line there is the straits have to be opened. And if they're not opened, this is a big problem. And if we we're not geopolitical experts, we have access to whether it's JP Morgan or all the best researchers in the world. Problem is, you've got three fantastically smart people saying one thing and three smart people saying the opposite thing. Nobody really knows what's going to happen. I think our broad take is that if we see about $100 oil for the next 3 or 4 months, then this is not too big a deal. We can handle it. Oil intensity has gone down, and $100, that's where we are. It's okay, and the market's probably already pricing for that. But we think that's probably the best case scenario right now. A Venezuela type situation is almost negligible probability. Troops on the ground may work. It's probably a 20% probability, but we have a lot more pain and uncertainty before we get a resolution, and we have no idea whether a resolution will happen. And the most likely outcome is some sort of taco, pick some sort of, we've won, let's go home. But really, I mean, even with the last set of news that we saw just before the US closed today, the market is kind of shrugged it off as Trump lies, basically. I mean, it doesn't really matter what he says. We need Iran to say that it's over. And what's actually happened is streets have been closed and they are benefiting massively from it. Russia's benefiting massively. Iran's benefiting massively in terms of the oil prices that they're getting, the revenues they're getting. I'm talking here about the people in control, not the population. Clearly, as a population, is being devastated. But I think they're holding most of the cards right now, and they'll play a hardball for a period. And so there's a reasonable chance that we see a meaningful shooting higher in oil prices. And I think the markets are still somewhat complacent about that. Only in the last couple of days has the S&P woken up to this. And so how are we positioning? We are conservatively positioned. If I think from an asset allocation perspective, we have benefited from oil exposure mechanically in the portfolio because the modeling work that Gavin and the team have done suggests that there is a 30 to 40% chance we're in a supply shock world, not in a demand shock world. And what do I mean by that? If demand shocks are what's driving the economy, the bonds and stocks are great, complements to each other. They're negatively correlated and they diversify you. And that's the world we've been in the 80s, 90s, 2000s, or late 80s onwards. The last 5 years, we've been in a world where commodity shocks, geopolitical shocks occur, and then bonds are actually your worst enemy for equities, and commodities are your friend. And I don't know which of those ones we're in, but what I can say is it's definitely not obvious which one it is. And therefore, there's a probability, probably 30%, that we're in the supply world, and that means you should own commodities in your portfolio. Whereas in the demand world, they're an ugly step cousin of equities that give you all the beta and none of the return. And therefore, there is no role for this. So we have 6 or 7% strategically in equity commodities right now, with 15% of equities, 10% bonds. And that's quite a balanced portfolio, so it's doing okay. In terms of the macro what we're doing, we have a barbell approach. I don't like to bet the ranch on any one thing. There are major dislocations in precious metals, in silver, platinum, gold. We own some of them. But we only own the third. We own the peak because they're 4 times more volatile. Right? There are major dislocations in the Egyptian pound and in various emerging market currencies and interest rate markets, where we're here to try and make money for our clients. We can start nibbling small into some of those markets because the expected returns are picking up. The gilt market is broken in the UK. We're pricing at 5% inflation, $150 oil prices already. Well, it might keep going if oil goes higher, but while the own oil, then we get everything to gilts. So this is the sort of balance that I've got, where we own oil, we own sophisticated assets, and then we own a significant amount of equity insurance, because I think the market is often not great at pricing relatively moderate probability events with devastating consequences. And I think there is a north of 20% chance that we see a 20% drop in equities in the next 3 months if this goes wrong. And it's worth having insurance against that, even if we're wrong, because if we're right, we'll be in such a strong position to take advantage of the opportunity set that it's worth doing just on that basis. And again, this is where path dependency matters. Unfortunately, we're a daily liquidity fuff, right? And people look at our price action daily. So there is a cost to that. It means we have to be better than average on timing because we don't have the luxury of being wrong. We're fortunate that we've had a very strong start to the year. We've kept most of it. I want to use that position of strength, not to again, but when the right opportunities occur in the right dislocations and we can structure them in a sensible way, then we can try to take advantage of them. And I think if I look across the hedge fund space, you'll get some pretty shocking numbers at the end of this month in terms of what we're seeing out there, because every asset is down and it's down big. There's only two things, oil and the dollar. There was nowhere else to hide. Not even the VIX really helped you. So just last thing on in terms of numbers, your headline on the shop, the US benefits from high oil prices. It makes sense that the dollar goes up, even if it's overvalued and should be debased over time or de-dollarized over time. It makes sense that it should go up because they're a net exporter and the activity hit in the US is much smaller than it is in Europe. It's probably 3 times bigger in Europe and Asia 5 times bigger. The inflation hit in Europe is much bigger than it is in the US. And so it makes sense the US is a bit, ironically enough, a bit of a safe haven here in terms of the dollar, in terms of the stock market. And Europe is in a real mess if this goes wrong. And Asia is in bigger trouble. And what we've seen in the last year is quite a lot of flow of assets out of the US into Europe and Asia and emerging markets. And I think that's one of the reasons why the pain net is so big, as people have de-geared, de-leveled these positions.
We were trying with this session to think about the positives and the opportunities of this chaos. I'll leave it up to everyone in the room to decide whether we've done that well between Suhail and I, but I don't feel so bad myself. I think we have one question, or we have some questions from the floor.
So how? Sure. Oh, thanks. I'm just wondering if I heard you correctly, you're saying a lot of the breakdown in correlations and dislocations in these markets is from deleveraging. If that's right, is this a voluntary, we don't know what's going on, we're just going to take our positions down, or is there, like we've seen over the last few years in certain markets, they've been forced on collateral issues? And whatever the case, how far do you think we're through that process when you go to the bar and talk to your peers, kind of thing?
Okay, so I think this is voluntary, not driven by collateral, not driven by margin calls from banks and so on. I don't think this is a March 2020 or even the first week of April 2025 type event, and it's definitely not the type of event. But there are tens, if not, there are probably 400 billion in multi-strategy pod shop type structures where their whole business model is dependent on cutting losses very quickly. So that's business as usual. But what's happened in this environment, in energy markets, in EM, in rates, there's been some big moves. So a lot of these pods, as part of the business plan, just get shut down. And the problem is when you have lots of people with similar positions shutting down, then that can have some sort of cascading event and you have a broader based deleveraging. So I think that's what's happening, but not in a manic state yet. Just, I wouldn't be surprised if we saw a bunch of -3 to 5% in the big multi-strats this month. That would be my guess. Not a -10 to 15. If it gets to the -8 to 10, that's where it really starts cascading. I don't think we're there yet. In terms of the actual deleveraging itself, the other thing that's happened, I would say, is CTAs have been reasonably, trend follows have been reasonably hurt because everything, when I look at my screen every day, all the crowded stuff is what's going down and all the shorted stuff is what's going up, right? Within the single stock space. That's a sign that deleveraging is continued. CTAs have probably de-geared about 2/3 of their positions. In emerging markets, they're out probably of 75%. We run a CTA, so I don't have to guess this. I can have a reasonably good guide. In equities, they're probably halved their positions in emerging markets in Europe, and they've already given up on the US because it's been going nowhere for 8 or 9 months. So I don't think there's much deleveraging left in the CTA space in equities. Macro actually has been really painful for many people in the short end of the UK gilt market. Was very painful for some. You'll see some headlines on that, I'm sure, or maybe you've already seen. So bottom line is voluntary based on risk discipline, but risk discipline can cause its own problems if a lot of people do the same thing. And I think some of that's happening.
No more time for questions?
Think we'll
All
have
right.
to move on.
Thank you very much, Suhail. That was extremely valuable. Hopefully everyone got a lot out of that in the room as well. So thank you very much.